Good morning. I have approximately 1 minute a slide, so I shall crack on. As you can see, there are quite a lot of us involved in this study, which is a study which spans several countries and has been a great source of interest to us all. The project was funded by the IAAER, International Association for Accounting, Education and Research, which does good work internationally. And we are looking at financial reporting by small companies. Now, this might appear to be a quiet backwater of research, enlivened only occasionally by the quiet plop as some shy vole of a paper disappears into the pool with hardly a ripple. But in fact, small companies are really quite important, and there are an awful lot of them. And what is distinctive about our study is that it's an international comparison, which hasn't really been done before. There are two issues which are prominent in finance and financial reporting research on small companies. One is an issue called the finance gap. It is hypothesized that there are barriers to growth in small entities arising from the fact that it's hard for them to grow their financing. And the second relates to financial reporting, which is believed to be a burden to these companies, both in terms of costs in direct cash terms and so-called proprietary costs. For example, the cost of revealing information to competitors or the cost of the proprietors losing privacy. Another reason why this is a topical piece of research is that the International Accounting Standards Board has issued a standard for small entities, or it's called the IFRS for SMEs, whereas in fact it can be used by any size of enterprise, provided that they are not listed companies or financial institutions. So a little bit of background about financial reporting for SMEs. The IASB asserts that the main users of published financial reports are existing and potential investors, lenders and creditors. And this is a point at which the problem becomes interesting to me and our other authors, because you have a disjunct between the theory about what financial reporting for SMEs is about and economic reality. Because the investors in SMEs are overwhelmingly the owners, who already have all the information available to them, so they don't actually need financial reports. Lenders are typically big banks who are much bigger than the SMEs and are large enough and nasty enough to look after themselves, and they can demand the information they need. So you don't need regulations about what SMEs provide. And that leaves essentially creditors, that is to say, generally suppliers to the company who are giving them time to pay, as the main economic parties who have an interest in the financial condition and stability of the SMEs with whom they are contracting. However, we know very little about how financial reports of SMEs translate into the granting or not of trade credit for the SME sector. And we know even less about how this is done for unincorporated entities, which generally don't have regulated financial reports. Very briefly, these are the profiles of the countries we looked at. We looked at Finland, small, independent economy, very tightly knit, everybody knows everyone. UK, with a huge number of small companies, at least 1.5 million, and where the SME sector is extremely important, certainly for employment, and where there's a long tradition of regulating financial reporting, so there's been quite a lot of information available, and the institutions which rely on that have arisen. USA, by contrast, has, again, very many small companies, but no regulations about their financial reporting. And just presaging our findings, one of the things we find is that the USA is an outlier. Usually USA and UK are pretty similar. Here, USA is not like anywhere else. And finally, South Africa, an emerging economy where there are a lot of small companies, but which has not had a very long tradition of financial reporting or regulation. The underlying theory about what might be going on would take a long time to discuss, but I want to point out one point, which is the idea of transaction technologies. Typically, the regulators who are setting up rules for small companies assume that there is either no information available or that all the information comes from the financial reports and that there is no other information of interest. And secondly, that there are basically only two types of finance. That is to say, either shareholders put in money or banks lend the companies money. And other possibilities, more complex transactions, are not contemplated. However, as Berger and Udell point out, that there are in fact a lot of possible transaction technologies for providing finance to smaller enterprises, which are more interesting and more complex than this simple equity debt model, which is something which we seek to explore. And finally, it is also assumed that the only thing that's interesting about financial reporting is a kind of one-to-one relationship between the finance provider and the entity providing finance, which ignores the possibility of systemic properties. That is to say that you can, for example, change institutions within the economy in order to make financing more efficient. The research design was essentially interviews of two small unincorporated businesses, two small private companies, two medium-sized companies, a credit rating agency and a credit insurer in each of the countries. We didn't quite achieve that in some, but we did pretty well. So we can regard essentially the researchers' case studies of these different countries linked together by a common approach. These are our main findings. Jumping ahead, essentially we can summarize the trade-credit relationship. One thing I haven't said, which I probably should have, is that in the countries we look at and elsewhere, the evidence is that trade credit is important. It's about as important as bank financing for small enterprises. The amount of money that they get from their suppliers as credit is roughly equal to the amount of money they borrow across the economy as a whole. So in this important this important financing, we have 9 possible relationships in our simplified schema, where you have a small, medium and large supplier, and a large, medium and small customer. And what you find is that where you've got a small customer, possibly granting, seeking credit from a small supplier, in all countries the relationship is always informal, and the credit granting decision is relationship based. People know each other and they operate within a limited sphere, and trust is important. Trust is a very efficient economic mechanism where it works, it's low cost, but it does depend on the availability of quite severe sanctions. Within small communities that exists because people can become ostracized if they don't play the game. Where you have, going to the other end of the diagonal, large suppliers granting credit to large customers, then you have very formal relationships. There's a great deal of information available. In Burger and Oodle's terms, this is a transparent transaction. What's more interesting is what happens in between. If you're a small customer or a big supplier, the big supplier has the overwhelming economic advantages and says take it or leave it. If you're a large customer of a small supplier, for example a supermarket buying from a small food manufacturing company, then the customer, as you might expect, dominates the relationship and takes what credit it likes. Although interestingly, we found that small suppliers were willing to supply large customers because although the large customer takes a long credit period, they do eventually pay. Payment is reliable, and the suppliers are willing to grant them credit. Looked at schematically, what seems to be going on is that where there is, in order to make a credit decision, the decider can either use formal report-based information or so-called soft information, information which isn't necessarily publicly available. There are a range of contingency factors which lead to the decision. We could say more about this in questions if needed. And finally, what we hypothesize is that as a business grows, the amount of finance that it can get as a proportion of the total needed in terms of relationship-based credit declines. But its access to formal credit rises. However, there's no rule which says that these rise and fall at the same rate. So there's the possibility of a trade credit gap in the middle here, where businesses run out of relationship-based credit before they can access formal credit. This provides a number of lessons which we think might be of interest to I'll skip over limitations. A number of lessons which we think might be of interest. For example, if you're a small company, you can increase your access to trade credit by publishing audited financial statements. This doesn't seem to be generally known, but your trade credit depends on whether you publish audited financial statements. Secondly, lesson for regulators, you don't necessarily do small companies a favour by relaxing their reporting requirements, because it deteriorates the system as a whole and impoverishes the institutions available for granting trade credit. And for financial reporting regulators, when setting standards for small and medium enterprises, it might just be a radical innovation to take into account the economic characteristics of those enterprises before writing down the regulations. That will do. Thank you.